Welcome, accounting superstars. Welcome to the Accounting Superstar channel. I'm Professor Don Bush, and this is accounting for pensions today. I've taught accounting for about 30 years and been a CPA for about that long also. I've got a lot of good ways to explain accounting, and we're going to learn our last lesson about pensions. We're working with a pension spreadsheet. This is when we get to a construction. The construction company you don't want to have work on your house. So here we go, folks. So this is the fifth lesson. That means that there are 4 prior lessons. So if you have a hard time understanding this, I would go back and watch each of those lessons. In fact, I would watch them in sequence, because they're made in such a way that they get a little bit more difficult as we go. So here we are. This is what's happening. I think today you're going to find out that accounting is a very political process, and it's not a perfect process. And I think that we're going to have big problems with pensions, public pensions, government pensions, and I have a feeling that accountants are going to get the blame for it. There's something that really doesn't smell very good here working with pensions. And in example 4, I gave one example of this, but in example 5, it is much, much worse. So hold your nose and let's get started. Here we go, example number 5. This is it. So here's what it's all about. Over here on the left-hand side, we have items that are happening here. These all involve the pension. Over here in the middle, we've got entries that are going to help generate a journal entry. And here's the journal entry right down here along the bottom. And on the right-hand side, we've got a representation of what is happening inside a third party who is taking care of the pension, who are investing the assets and monitoring the pension, and also making payments out to workers, former workers. It all starts out with the beginning balance here, January 1st, 2005, and we've got these numbers over here. So I'll start with the pension assets. So according to our third party, independent third party, we have pension assets of $16,500. It's listed here as a debit. And we have a projected pension liability of $23,223, which is not very good. This means that they are underfunded. They're going to be running into major problems in the future. And this is the present value of pension payments, not the actual payments that need to be made. Now, if you have a $16,500 debit and a $23,223 credit, that means that it all balances out here to a $6,723 credit pension asset liability. Now, this is on our books and on our when we get to a construction books, and it's listed here as a pension liability, and we know that because it is a credit, and we can also tell because the projected pension liability is way bigger than the pension assets. So coming over here to the employee service cost, well, our current workers have been working hard, and they have earned $5,000 of pension benefits to be paid into the future, and so we'll have a pension expense of $5,000 debit. And we have a $5,000 credit because this increases the liability. Employer contributions to plan. Well, the employer this year has made contributions that are larger than the employee service costs. So who would have thought that? So $6,000 credit, and we put it over here in pension assets, $6,000 debit. So you got to make sure that these lines balance horizontally. The debits equal credits. And of course, this very first line, that's not true, but all this is just a summary of what's going on over here. The interest cost, I've got here 5% of beginning liability. Now, why did I choose 5%? Well, I just chose it. Our actuaries, people that help us make predictions and who are good at statistics and probabilities, would help us come up with this interest rate. Now, anytime you're dealing with money that happens out in the future, there's an interest component. Again, this $23,223, that is the present value of future payments. So it's not the actual payments. And so we need an interest component. So here we have 5%, so I'm just using 5%. Let's just pretend that the actuaries told us to use 5%. So what do? You just take 23,223 multiplied by 5%, and you get 1,161. This interest cost, it increases the pension expense, so we have a debit here, 1,161, and it increases our projected pension liability by 1,161, and it's a credit, and we balance horizontally. Now here we get down to something that I've got in bright yellow here because I wanted it to stand out, and I've got also another bright yellow line down here that stands out. The two are related, and I'll explain how they're related. And this is where funny things are happening with the accounting, and this is where I think accountants are going to get the blame for this, and we might have another Sarbanes-Oxley type of thing happening when this all comes out. So letter D, actual return on pension assets. Well, the third-party pension trustee did a good job investing the assets and had a return of $2,000. Now this return on investment, it reduces the pension expense. That's why we have a $2,000 credit, all right? And since we increased the pension assets, or we didn't, the third-party pension people did, we are going to debit the pension assets for $2,000. So all is good. And this entry right here, I don't have any problem with. That's a very legit type of entry. Letter E, benefits paid to workers. Well, the benefits paid to workers, $4,000. These are workers who have retired, so it's reducing the pension assets, so we're crediting pension assets, and we are reducing the projected pension liability because we're paying off some of the liability. So that is easy also. Amortization of prior service costs. We learned about this in example number 4, so if this is not making sense, go back and watch that example or watch it again and make sure you understand it. Amortization of prior service costs, this happens when pension plans are amended. Something odd is going on here though, is that we're crediting other comprehensive income, and it's something that I don't really care for. What other comprehensive income is when certain expenses, certain revenues bypass the income statement, and I believe, this is just my own opinion, I believe it's more of a political process, that there are parties that do not want to have certain things show up on their income statement, and they use the excuse that it reduces volatility, but for me, I don't really buy that excuse. I guess I'm being a little cynical here today. So here we go, amortization of prior service costs. So what's going on here? In example 4, we put a whole bunch of prior service costs into the equity section of the balance sheet. It bypassed the income statement, and now what we're doing is we're writing that off little by little. We're amortizing it, and we're running it through the pension expense, and it eventually ends up again on the balance sheet in the equity section. So it's kind of like a big giant circle, I guess. So we debit pension expense for $500, debit, we credit other comprehensive income, and specifically under prior service cost here. Over here to the unexpected loss. Now this is the thing that I think is just blatantly a bad thing to do here. I just totally disagree with this. But this is the way it is done, and I think it's going to come back to bite us all. And what it is that actuaries and companies, they like to predict, and they should predict too, what they think their return on pension assets are going to be in the future. Now, this company here predicted, they estimated that they would have an actual return on pension assets of not $2,000 but $2,300. That is what they were hoping, but it didn't happen. They still did well, but not as well as expected. And it turns out that they were off by $300. They expected $2,300. They wanted $2,300. They are basing their calculations on $2,300, but the actual return was $2,000. Still not a shabby return. So what's going on here is that they are putting here unexpected loss, $300 credit. Now this is where it gets weird. It is that you would think a loss should be a debit and it should increase your expenses here. But in this case, they are decreasing their expenses. So this is where it is weird. And what they're doing, they are bypassing the income statement and they are putting it over here under gains and losses, $300 debit here. So they're sending this deficit of what they expected through other comprehensive income. They're skipping over the income statement. So essentially, and here's the punchline, this is the part that you want to catch if you want to understand this. If you take $2,000 and $300, you get $2,300. And that was their expected return. That's what they wanted. So what they're doing is, even though they did not receive a $2,300 return, which they were expecting, they are reducing pension expense by what they expected nevertheless. So they're living a little bit here in fantasy land here. They're reducing their pension expense by what they expected. Now, I've heard it said that with pensions that a lot of the estimations are the average rate of return on the stock market over a long period of time, which is about 6 to 7%. And that's not happening. It's not happening in the bond market either, where a lot of pension assets are invested. It's not nearly so happening in the bond market. In the bond market, today it's about 0.7% for a 10-year treasury yield. And they are expecting 10 times that much. Well, it's not happening. But nevertheless, they are reducing their pension expense by what they wanted, not by what happened. So essentially, pension expense is being vastly understated on the income statement, and it's being rerouted to other comprehensive income. So moving on here, liability increase 4616. Where'd this come from? Our friends the actuaries looked at the pension plan and they thought, our projected pension liability, it's not quite enough what it should be. It ought to be increased by $4,616. And so we're making an entry, and that too is bypassing the income statement and going to other comprehensive income. So we have huge amounts that are bypassing the income statement, don't show up as an expense. And also the third party here that's taking care of our pension for us, it's going over here. So our horizontally we balance, and as you know, every single line needs to balance horizontally. So here we go. We're going to figure out the journal entry. So what we need to do is we need to total up our columns. So with pension expense, we need to total this column, but you got to be careful and make sure that you watch for these credits, because you will subtract the credits. So add the debits, subtract the credits, you end up with $4,361 debit. Cash is being credited by $6,000. There you go. Other comprehensive income, prior service cost is being credited for $500. And other comprehensive income, gains and losses, $300 debit, $4,616 debit. Boy, a lot of stuff that I think ought to be pension expense is bypassing the income statement. Which means to make this all balance, we would need a credit of $2,777 to make this all balance. So what you want to do is, if you didn't know that this was $2,777, which you do because I've got it listed right there, you'd have to add up your debits, add up your credits, and see what it takes to make this thing balance. And it takes $2,777 of credits to make it balance. So coming down here to the bottom line, and then we'll be done with this spreadsheet. Pension assets starts out $16,500. And by the way, this is the beginning balance. It was the ending balance in example 4. So the beginning balance of example 5, it's a debit. add debits, subtract credits, you get $20,500 debit. Projected pension liability starts out here at $23,223 credit. Add up your credits, subtract any debits, you get an even $30,000 credit. Now, to make this all balance, this has got to be $9,500 credit, all right? Because we've got $20,500 debit under pension assets, projected pension liability, $30,000 credit. That means we are vastly underfunded, which is typical and normal for most pensions. And that means that on balance, if we net the two together, we would have a $9,500 credit. Now, we need to check this vertically also and make sure it all equals. So pension asset liability, $6,723 credit. Let's add another credit of $2,777, and we have a final balance of $9,500. So either way, if we add it up vertically or horizontally, we get $9,500 credit. So coming down to the journal entry. The journal entry is pretty easy now that we did all this work. All we do is take these numbers and form a journal entry. So pension expense, $4,361. Let's see here. Other comprehensive income, gain and loss, is a debit of $49.16. It's coming from right there. Other comprehensive income, prior service cost, $500, coming from right there. Cash being credited for $6,000 comes from right there. And pension asset liability, $2,777, makes it all balance. We're getting it from here. Now, we are severely underfunded, so it's going to go under here on the balance sheet. Non-current liability, pension asset liability, and it's a liability here, $9,500 right there. Okay, so folks, that is the story of how you account for pensions. So this is the final example. If you're a little bit lost, go back and watch the prior examples. If you like this video, let me know, and I'll make some more for you. And hit that like button. That way I know that you guys are watching these videos, and subscribe too. So until next time, over and out.